Greg Abel's first major acquisition as Berkshire CEO closed in a weekend. On May 31st, Berkshire announced it would buy Taylor Morrison for $72.50 per share in cash. That is a 24% premium to the prior close of $58.50. Total enterprise value, $8.5 billion. The surface read is straightforward. Housing fits Berkshire's DNA. Berkshire already owns Clayton Homes and a cluster of building products businesses. Abel framed the deal in exactly those terms, unifying site-built home building under one platform. Taylor Morrison earned $783 million last year in what analysts called a down housing market. That is a 13% return on equity, the kind of number Buffett would have circled. But here is what the surface read assumes, that the housing cycle is either bottoming or that Berkshire can outlast the cycle. The article pool surfaces the buried assumption. Analysts at Alloy Advisors note the deal makes sense because the U.S. faces a shortage of 3 to 5 million homes. That assumes the shortage resolves through new construction, not through demand destruction from elevated rates. New Fed Chair Kevin Warsh took over from Jerome Powell last month into a rising rate environment. Mortgage rates have moved up since the Iran conflict began. If rates stay elevated and the 3 to 5 million shortage resolves slowly, Taylor Morrison's earnings runway is long. If rates force a demand pullback before supply normalizes, the 24% premium Abel paid becomes harder to justify in the near term. The deal is classic Buffett cycle timing. Buy into a sector when others won't. NVR has surged 62,000% since 1996, doing exactly that kind of long-duration homebuilder bet. But NVR operated in a period of declining rates. That assumption no longer holds automatically. The first tension is pricing cycle risk. The second tension comes from what Abel did the next day. 24 hours after the Taylor Morrison announcement, Alphabet priced an $84.75 billion equity raise. Berkshire anchored it with a $10 billion private placement. That is 14.2 million Class A shares at $351.81 and 14.4 million Class C shares at $348.20. Berkshire had already tripled its Alphabet stake in Q1, making it 6.7% of the equity portfolio. At current prices, Alphabet trades at approximately 28 times trailing earnings. Buffett and Munger built Berkshire on free cash flow. Alphabet's projected 2026 free cash flow is $26 billion. That is down from more than $73 billion last year, a 64% compression in 1 year. The compression is deliberate. Alphabet's 2026 capital expenditure guidance is $180 to $190 billion, nearly double the $91.4 billion spent in all of 2025. Google Cloud revenue hit $20 billion in Q1 2026, 63% year-over-year growth. The contracted backlog nearly doubled in a single quarter to $462 billion. The bull case Abel is buying. The backlog is real demand, not projected demand. CEO Sundar Pichai told analysts, "We are compute constrained in the near term. Cloud revenue would have been higher if we were able to meet the demand." Here is the assumption that the bull and bear sides disagree on. Both assume the $462 billion backlog converts to revenue before the capital spending cycle peaks. Bears assume the CapEx cycle extends beyond the backlog duration and that depreciation pressure compounds before the AI revenue ramp closes the gap. Abel's move signals he is buying the bull read, that Alphabet's moat, 85 to 90% search market share, a monopoly designation by a federal judge, and an accelerating cloud backlog justifies a compressed free cash flow window. But this is not the Berkshire framework that held Apple as a consumer habit moat with minimal capex. Apple was not spending $180 billion a year to maintain its position. Alphabet is, and Abel bought more of it. That is the second unresolved tension. Now the two moves together raise the deeper question.
For 14 consecutive quarters, from October 2022 through the first quarter of 2026, Berkshire sold more stocks than it bought. Total net selling over that stretch, approximately $194.8 billion. Berkshire ended Q1 sitting on $397.6 billion in cash and Treasury securities. The Buffett indicator, market cap to GDP ratio, hit an all-time high of 227% on April 30. Buffett considered 88% the historical norm. He was selling when it was far lower. Then, within 48 hours, Abel deployed $16.8 billion into two assets that could not be more different in their investment theses. Taylor Morrison is a cyclical, capital-intensive homebuilder bought at a 24% premium. Alphabet is a hyperscaler spending $180 to $190 billion in capital expenditures in 2026 alone. One is a Buffett-era value frame applied to housing. The other is a growth-era bet on AI infrastructure dominance. The market's current standing read on Berkshire is that Abel is Buffett's disciplined successor, more operational detail, same value discipline, same patience threshold. BRK.B shares are down 5.8% year-to-date versus the S&P 500's gain. The market has been pricing a discount for the transition, not a strategy divergence. If the two deals in 48 hours are coincidental timing, separate decisions that happen to land on the same weekend, then the standing read survives. Said if they represent a conscious opening of Berkshire's deployment bandwidth, housing value, and AI growth simultaneously, the standing read breaks. The critical distinction is not what Abel bought, it is whether Berkshire will now begin drawing down the $397.6 billion toward that two-direction framework. Q1 operating earnings grew 17.7% year-over-year. The insurance business is softening. Abel said it himself at the annual meeting. The insurance environment is becoming more challenging, with more capital coming into the industry. If the insurance earnings cushion compresses to the back half of 2026, the $397.6 billion is no longer purely defensive positioning. It becomes the active capital base for a new deployment cycle. For BRK.B holders, the monitoring variable is not the deals themselves. It is whether the next quarter shows a third deployment in a different direction, or whether Q2 returns to the 14-quarter pattern of net selling and cash accumulation. That is the confirmation signal. One 48-hour window does not rewrite a 14-quarter pattern. Two windows in two different directions would. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.